Good afternoon, folks, and welcome to today's Wednesday webinar, The Power of Exchanging a Traditional Loan for a Reverse Mortgage. 10 Powerful Ways to Supersize Retirement Outcomes. I'd like to thank my sponsor, Retirement Funding Solutions, and High Point Law Offices, as well as the American College for sponsoring me for these webinars. You were here either because you were a troll or most likely because I or someone from Retirement Funding Solutions invited you or someone you knew. I'm Don Graves. I'm an adjunct professor in retirement income at the American College. I'm the president of the Heckham Institute for Housing Wealth Studies. Our signature course will be released in October, which is the Housing Wealth Certified Specialist, 4.5 hours. I'm a business development consultant, and I work with the Retirement Funding Solutions, but most importantly, 18 years, not 16, 18 years I've been working with the reverse mortgage in some capacity. Particularly advisors in the current course at the American College. I have a little less than 16,000 advisors going through that course. And we talk about retirement. Retirement for many years had been the focus of many commercials, articles, but we know retirement is distinctly broken up into two categories. Here's Mount Everest, a picture of Everest. And on the one side of Everest, there's going up the mountain, asset allocation. And this time, you're focused on climbing the mountain. It's the accumulation of wealth, getting up to the top. And once you get to the top of the accumulation side, you strike a pose and you said, we made it, and you prepare on the way down. But what many people have discovered is that the mountain was a little bit bigger than they imagined, and they had not quite made it to the top and preparing for the descent. So let's put him on the top. Now, coming down the mountain of retirement is focused on income allocation, making sure you have enough money to make it the entire journey and focusing on how to take your money. And here's what we know. The danger of Everest, the true mountain, is coming down. 2/3 of all the people who've died on Everest have died coming down the mountain. The American College has summarized the 18 major risks in retirement income: longevity risk, inflation, excessive withdrawal risk, market risk, sequence, liquidity, and so on and so forth. You can get a download of a 9-page summary we developed called the 18 Risks of Retirement, Housing Wealth Edition, at 18risk.com if you want it. Here's the point, that coming down the mountain and the risk associated with the decumulation side exacerbate these risks, and we have to be prepared to help our clients. There are 2 books on these, Retirement Risk, written by Jamie Hopkins, and I did a summary that I made available to Curtis Cloak. He turned it into 18 Risks That Can Derail Retirement. Again, you can have that at 18risk.com. So our typical retirement planning picture is focused on the client's income, investments, and insurances. Insurances include annuities. They include a business that you may sell in the future, a second home, and your investments in your income, Social Security, and some sort of pension. And you have to develop that into a withdrawal strategy, systematic withdrawal, bucketing approach, or flooring approach. And Dr. Wade Pfau says there are 39 hybrid ways you can do it, but they all focus on the 3 primary buckets: income, investments, and insurances. And the question is this planning model sufficient for today's retiree? Well, who is today's retiree? Here they are on the screen. Do you know who that is? Of course you do. Someone just yelled out the Rolling Stones. I'd say no, the Strolling Bones, because they've gotten really old over time. Born between 1946 and 1964, 10,000 a day turned 62. But what's most important to the people on this call is 10,000 a day have begun to turn 70 and a half. The largest transfer of wealth from qualified plans into the accounts of these folks is happening right now. They've got 3-fold problems. They're going to live longer. The majority of them have not saved enough to sustain a long retirement, and 68% of them are going to carry some sort of debt into retirement, up to 68%, some sort of mortgage-related debt into retirement. Now, the good news is 87% of boomers own a home, 87%. That's going to be the saving grace of the retirement boomer. that they own a home. The major concerns that we've covered time and again are the 4 L's: longevity, lifestyle, legacy, and liquidity. Longevity, will they have enough money to meet their basic living needs? That's typically the number one concern of retirees. Lifestyle, will I have enough to maintain my standard of living? Some will say, I can make it, Don, but I'm going to have to cut some of my lifestyle when I don't want to. Legacy, will I leave a lasting impact? How will I be financially remembered? That doesn't mean you left money to your children. It may mean you didn't borrow money, didn't have to move in with them, or one of them didn't have to quit their job to take care of you medically in the out years of your life. And then liquidity. Will I have access to tax advantage money when I need it? Those are the 4 biggest concerns that retirees have. I tell advisors, in some way, shape, or form, you're probably already doing this, but start with the 4 L's when you're talking and doing your annual review or your initial consultation, and find out what the pain point is right there. So the typical retirement planning picture asks the question: income, investments, and insurances. I think a phone is ringing somewhere. I'm going to put these on Do Not Disturb in my office because I can hear that. Sorry about that. But what happens when we add housing wealth to that picture? Housing wealth. How does that change? Well, what is housing wealth? I'm speaking of housing wealth as the money that the typical retiree has in their home equity. The U.S. Census Bureau says the average retiring married couple will have around $92,000 saved, but $192,000 in home equity, meaning that 68% of their total wealth is in housing wealth. So what is a reverse mortgage? A reverse mortgage is just a mortgage. 4 words that are very, very important for you to understand. It's just a mortgage. When you can understand that, when you can get a hold of that, that changes a lot of things. You mentioned reverse mortgage at a barbecue, and you got to be careful. Someone may rise up and try to shank you. You know your aunt who went to prison. She still knows how to make something out of the plastic knife. But the home equity conversion mortgage, that's the official name. That's the name that I encourage you to use. It's a federally insured loan developed by Congress 29.5 years ago that allows retirees 62 years or over to convert a portion of their home's equity, turn it into tax-free money, while having the flexibility of making or not making a loan payment. You don't give up ownership or come off title of the home, and you will not repay more than the home's worth. That's the basics of the HECM. Today's webinar is not about the basics, but we're going to do a quick review. How much money can you get? Well, the amount of money gets based on 3 building blocks: the age of the youngest borrower, the value of the property, and the interest rate associated with the program. A reverse mortgage must be a first mortgage. That's what we're talking about today. So any existing mortgages, second mortgages, home equity loans, liens, or judgment have to be paid off. And a typical 65-year-old today can look to receive around 50% of their home's equity, 50% of their home's value up to the lending limit. So what are the spending options? You can have the money in a lump sum. I can't give it to you all in 1 year. I can give it to you in 2 years. So I'll back the dump truck up 60% the first year and the rest after that. The line of credit, you can have a monthly tenure payment, which means Don send us a check every month for as long as we live in the home and maintain this loan. Great. Monthly term payment. I only want money for 4, 6, or 8 years, maybe 10 years. Why would someone want that? Well, maybe mom or dad needs home care. Maybe we're looking to defer Social Security from 62 to 70, or defer annuitization that the dollars can be vested longer, or defer taking money from our IRA until we get 7.5. There are all types of reasons that you can take a monthly term payment using a reverse mortgage to supplement that, or you can use a combination. And finally, the loan gets repaid when the last surviving borrower permanently departs the home, moves, or deceases. At that time, whatever money was advanced to you, plus the interest that accrues, gets repaid, typically from the sale of the house, and 100% of the remaining equity is passed on to you if you move, your client moves, their heirs, or their estate. Now, that's the basics of a reverse mortgage. Today, we are talking about the power of exchanging a traditional loan for reverse mortgages. 10 powerful ways to supersize your retirement outcomes. We're going to look at Carlos and Sylvia Montini. Age 65, their current retirement savings is $750,000, and they've got a bunch of money in cash, $350,000 CDs, money market, and cash. I don't know why they have that much, but here was an actual case study that we sent to Money Guide Pro a few years ago. They have a $550,000 home, and they've got a mortgage payment, or they've got an outstanding balance of $170,000, to which they're paying around $1,200 a month, and they've got 20 years or 240 months remaining on that. So here's what this tells us. It says that Carlos and Sylvia are in a retirement position that looks pretty good, but they've got this existing mortgage payment. What can be accomplished if they get rid of the existing mortgage? So if they do a HECM replacement, which is simply replacing their traditionally amortizing loan for a HECM, it's going to make $296,641 available to them. What do we do with that money? Well, the purple says we paid off their existing mortgage. We left them with a little money, $4,600, and then we left them with a line of credit, $119,240. So that's their replacement. Eliminated the $1,200 a month payment, established a $119,000 RELOC. Now, RELOC is a reverse mortgage line of credit. Dr. Tom Davidson called it a retiree's line of credit, but it's a reverse mortgage line of credit as opposed to a HELOC, so a RELOC. Today, let's look at what this can accomplish, 10 things that happen. Before we do that, I want to tell you about this line right here because it's going to come back, and I want you to understand in case you've not been to any of the other webinars. The blue line is the market. The Dow Jones, that was 2015 to 16, it's a roller coaster ride. And the green line is something different, something only associated with today's HECM. And the question is, think your client wants to know what that green line is. Well, it's called the reverse mortgage line of credit. It's one of the ways that you can use the proceeds of a reverse mortgage. So Carlos and Sylvia, they got rid of their existing mortgage with a HECM replacement, and then they had the line of credit left over of $119,000. The way the program is structured and has been for 29 and a half years is that $119,240 is going to grow. It has a built-in guaranteed growth factor. Today it's around 6%. So Carlos and Sylvia, if they don't touch it for the next 31 years, it's grown to $758,000, nearly $759,000. So a couple that had a $400,000 home would have a line of credit of around $204,000. Look how that grows. And a $600,000 home produces a $311,000 line of credit for a 65-year-old, and look how that grows. So I'm going to pause here on this screen to let that soak in. This was the shot heard around the world several years ago. Many times in speaking to advisors, they would say to me, Don, the reverse mortgage is too complicated, it's too expensive, it's not for my clients. One fellow says it's an equity stripper. I said, what is that? It said, doesn't make any money left over to the children. I said, well, just hold on for a few minutes. And the most common refrain was it should only be used as a last resort. That was FINRA's stated and written position, should only be used as a last resort. Until Dr. Barry Sachs and his brother Dr. Stephen Sachs took that and wrote the first article in the Journal of Financial Planning, 2012, that really took the task. Was that scientific? Did the math and science add up to that position? And they eventually went to FINRA and presented this to them, and FINRA said, you're right. Using the reverse mortgage as a last resort is not the best way for the majority of mass affluent baby boomers. And they changed their written position. A lot of people do not know that. But that was built on this concept of the reverse mortgage line of credit, the RELOC, that being able to set up and establish this early in retirement gives you a competitive advantage. Again, I do a whole seminar on this, and we teach that in the course, so we won't cover that today, but I want to go behind the chassis just a little bit, and then we're going to talk about the 10 ways that eliminating a mortgage payment, a monthly mandatory mortgage payment, helps your clients. But let's talk about how the reverse mortgage line of credit grows, and then you're going to see the importance of it. So here's a client with a $400,000 home, and they've got a $100,000 mortgage balance. You see that? So the principal limit, that's going to be the amount of money the reverse mortgage makes available, is $200,000, about 50%. Now their outstanding balance, we paid off their existing
folks. My name is Elise. I'm Don's assistant. It looks like we're having a little bit of technical difficulty. Just give us one moment and we'll get Don back on the line.
All right, folks, I'm back on a different line because I think I lost some of you, and I do apologize for that. So you won't get the crisp, clear, professional broadcaster sound, but you're going to get something different. So what I need to do here is I'm going to bring my laptop in. At least can you dissociate that? And if you can hear me now, would you let me know in the section? Let me know I can hear you. Kevin, can you hear me now? I think that was a Sprint commercial. Dave, thank you. You can hear me. Super, 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 super. I'm going to try to come back here, make sure I'm connected. Well, I tell you, technology can fool you every now and again. It can be a real snafu. So let me go back here. And let me log back in. Thank you for your patience, by the way. All right, so let's get back. All right, folks, I'm back. Let me know. Chris, you can hear me. Carlos, can you hear me? Can you see my screen now? Because I just put up $210,000. I should sue Comcast, shouldn't I? You think I'll be successful with that? I don't think so. All right, thank you, Kevin. We can see the screen. So the principal limit means the amount of money you borrow. That's the reverse amortization feature of the reverse mortgage. So the next year it grows to $210,000. Your outstanding balance grows to $110,000, and the difference between those two is $99,750. $99,750. So years 2, 3, 4, and 5, I want you to notice what happens. The principal limit grows because it always grows in a reverse mortgage. That's the reverse part. The outstanding balance grows, and the difference between those two is the line of credit growing as well. And let's go on out to year number 30. So now by the time we get to year number 30, you see the line of credit is $410,000, assuming they've not taken any dollars from that. The reason I share this is because some folk will say, Don, I don't understand how the line of credit grows. You can see this. You can go to RELOC, RELOC.net, RELOC.net, and you can see this again, plus the explanation in case you don't get it here. It's just a post I put up. So the powerful feature of the reverse mortgage is that the line of credit continues to grow. Now, having that in mind, how reverse mortgage works, how the line of credit works, it's just a mortgage. Let's look at the 10 powerful ways to supersize retirement outcomes. Number one is a budget bridge. Now, before I start here, I don't have it on the screen, but if you're there at your desk or listening or have access to the notepad on your phone or tablet, I want you to write down what could possibly be the best question that you'll ask some of your clients. Are you ready? I'm going to give you my secret question number one. Now, typically, this is part of the course. You have to pay. This is module 5. You have to pay for this. But I'm going to give you the secret right here. Are you ready? Here's the question I want you to ask your clients. Bob and Peggy. Don't say that because that may not be their name. What would life be like? What would retirement be like if you didn't have to make a monthly mortgage payment? Let me pause because I want you to write that down. What would retirement be like if you didn't have to make a monthly mortgage payment? Did you write it down? Fantastic. Now, the way they answered that question, is going to say a lot about how we move forward. Now, let me pause for a moment. Someone said my slides are stuck. So let me refresh this and see if I can get them unstuck. All right, are they unstuck now? Slides are not changing. I'm going to have my assistant come here and see what's happening. I'm sorry about this, folks. We have a new system here. And so at least let's see if we can change the screen. They're still not moving, Mari. I'm sorry about that. I've done this for 3 years, and it's the first this has happened. So I'm going to try to switch presenters. If I can't do that, I'm going to hang up and dial back in. All right, I'm going to change presenters here. Now, can you see my slides now? Let me know, please. All right, now you can see it. Fantastic, thank you. Let's see if we can get this started again. All right. So the first thing is a budget bridge, And let me go to your questions here and make sure. So this says that Bob and Peggy here have a certain desired spending amount. That's the black line there. And their budget has for this much. But what they really desire is the line above that, which is I want to spend more, but I don't have that. If you're able to eliminate their monthly mortgage payment, that means you're adding $1,200 a month or $1,000 or some people $1,750. I had a fellow called yesterday. He had a $4 million home and his mortgage was $1.8 million. Taxes were $25,000 a year. And though he had $3 million, he didn't have the cash flow to sustain that. So a budget bridge means by eliminating a monthly mortgage payment, you're able to give your clients guilt-free enjoyment and that they can move and live in this green zone here. That's a HECM augmentation. All right, David Torres says, Don, your slides in the presentation are a bit small. David, thank you for saying that. Maybe this is just not our day, folks, and I apologize for that. So let me try to remedy this here. Give me 1 second, please. And thank you for bearing with me and showing some patience. And here's my promise to you. If this doesn't go like I want, I will re-record the whole thing and send you, I'll just record it and send you that recording, and somehow doesn't go the right way. I do apologize here. So let's try to figure this out. What are you all seeing on your screen right now? And I'm going to go to my office, another computer. Again, we had some technology issues with Comcast today. But let me know what you're seeing on your screen right now. David said it seems a little small, and we want to fix it. Okay, you're seeing the slide plus the preview. I got it. Let's see if we can change that. And that's because I have a double monitor. All right, now tell me what you're seeing on the screen. Bingo! Yes, Great. Yes. Thank you. Woo. Okay. Fantastic. So let me go back to number one. Budget bridge. By eliminating a mortgage, here's a client that has a desired spending, but their budget is at a certain level. By eliminating a monthly mortgage payment, here's what you're able to do with your client. You're able to bridge that gap for them. And that creates lifestyle. So the first thing a reverse mortgage does, eliminating a monthly mortgage payment, is you create lifestyle for your client. That's typically when you ask them, Bob and Peggy, what would retirement be like if you didn't have to make a monthly mortgage payment? The first thing you're going to hear is a sound that sounds like this. And then you're going to hear an explanation of what they'll be able to do with their dollars. Number two, making their money last longer. The number one concern of retirees is my money going to last? So can we reduce the draw on the portfolio? Yes. By eliminating a monthly mortgage, you're saying to your client, well, now the money you were drawing out every month, we can reduce that by $1,200. So in the example we sent to Money Guide Pro, that's exactly what we asked them to do. If this client doesn't change anything, they continue at their similar withdrawal rate, what's their probability of success? Money Guide Pro sent back to us and said 58%. We said, what if we eliminate a mortgage payment and in essence reduce their draw, reduce the amount of money they have to draw? Does that make a difference? They said, yes, it does. It increases it to 96% probability of success. You see, that's a longevity concern that has been solved. When you eliminate a monthly loan payment, you're creating longevity for those who are in the distribution phase. Here's a very simple example. A smaller portfolio of $300,000 and they're going to draw $2,000 a month. It's not sustainable. They have an $800 a month mortgage payment, and using a few parameters, we said, well, you're going to run out of money at age 81. If we can eliminate the mortgage payment, you see here, now their monthly draw is $1,200 a month because we took away the mortgage payment. What happens? All things being equal, same interest rate, the money lasts 10 more years. That's the waterfall. By eliminating a monthly mortgage payment, you can create lifestyle, guilt-free enjoyment. You can create longevity because of the portfolio. Number three, mitigating sequence risk. If I can eliminate a monthly mortgage payment, what am I doing? I'm reducing the amount of money you have to draw from your savings, from your portfolio. So here's a very simple example of a lady who had $100,000 and her returns here in the early part were negative. This client, because she's drawing $5,000 a year, she runs out of money. But if we simply switch the returns, that the negative returns happen later and we stay positive, she doesn't run out of money at all, ever. You see? Now let's look at two couples. And we're going to see that they have the same amount of money retiring, the same allocation strategy, drawing the same money from the same investments on the same day, but they had a different advisor. Now, one advisor had a particular strategy that said, listen, we're just going to let it ride, and if you ever need a reverse mortgage, we'll do that if you run out of money. So I want you to notice a few things. Here in this example, they're drawing out $27,500 in the first year, and we're going to adjust it for inflation after that. The pink numbers are negative returns in years 1 and 2, 5 and 9, and then year 22. So by year 23, they have run out of savings. They've run out of savings. They call their advisor, and they say, Bob, we're out of savings. And Bob says, well, now we're going to do the reverse mortgage because you're out of savings. And great, they do a reverse mortgage, and it lasts them another 7 years. So they had 30 years of retirement. That's not bad planning, is it? I don't think you can do much better than that. Or can you? So an alternative strategy was to say, let's not take any money from savings after a negative return year. That gives the portfolio time to recover. The client smiles. They said they're happy, and 30 years later, you show them you won't run out of money in year 23, but 30 years later, you have $1.1 million. But they ask the question, how do we eat and live in those years? Well, you know the answer to that. You say to them, we're going to establish a reverse mortgage line of credit. We did that when we did the reverse mortgage line of credit exchange. We left you with a $119,000 line of credit. And so we're going to draw from that line of credit in the years following a down year. You see that in the yellow. But here's what's most important. I don't have it modeled out here. But they don't need $28,000 for 63. You see that in the yellow? They don't need that first year of following a negative return. Why don't they need that? Because we've eliminated a $1,200 a month payment. So we've eliminated nearly $15,000, $14,400. So they don't need $28,000. They only need $14,000. So the line of credit supplements and functions as a non-correlated asset, not correlated to the market, allows them to draw from that versus their savings, and we've reduced that, and we've functionally mitigated sequence risk. There it is. So from $27,500 to beginning initial withdrawal rate of $13,100. That's what we've done. So eliminating a monthly mortgage payment helps your clients overcome or prepare for any type of sequence risk or just market risk. It doesn't have to be early negatives. It could be any negative, and if they don't want to withdraw the following year, they can use it from their savings or their reverse mortgage. Number 4, deferring withdrawals. This comes from the Social Security Administration. You all know this. Full retirement age 66, shows a client getting $1,000. If they take it at age 62, it's $750. If they wait to age 70, it's $1,320. Not only is this with Social Security, and of course if you're getting $2,000 at full retirement age, it's going to increase proportionately, but this is for a person who has annuities. And your annuity person says if you keep the money vested, the longer you keep it vested, the bigger the payout period, the shorter your retirement horizon. This happens with qualified dollars. The longer you keep them invested, up until 70.5 when you have to take them, the greater opportunity you typically would have for growth. But the average person today is still taking their Social Security at age 62. Why? Because they need the money. Well, if you're able, listen to this, if you're able to eliminate their monthly mortgage payment, because that's what this is about, and now you give them $1,200 a month, $1,200 a month, maybe that's sufficient as a bridge, or maybe it's not, but they have the $119,000 reverse mortgage line of credit. So they can optimize Social Security because you've given them $1,200 a month, not paying a mortgage payment. They can live on that. And if they need a little bit more, they can pull it from the line of credit. How long will it last? 2, 4, 6, 8 years? I don't know. But you give them the ability to defer their investments, allow them to grow, and shorten their retirement period. How did you do that? Simply by eliminating their monthly mortgage payment. Number 5, benefit of eliminating a monthly mortgage payment is life insurance. I had a friend, I don't sell life insurance, but I teach a lot of people who do. The case for life insurance, pension replacement, estate planning, protect against stock market downturns, cover unexpected expenses, distribute assets equally among heirs. That's just a few of the reasons. But one of the questions is, and I heard a fellow, Tom Hegna, some of you know Tom Hegna from his PBS special, his talks, and Tom Hegna talked about that most life insurance is purchased by people over the age of 62. And if life insurance does all of this, a client often will say, I see it, I see the value, I want to use it not only as an income replacement tool, but to provide for my wife. I can't afford the premiums, Bob, or I don't want to do the premiums. He said, well, the premiums are $500 a month, $250, $800. And they see the value, but there's an obstacle. Now imagine you saying to your client, if we could have you get this insurance for legacy or estate planning or whatever you want, and it didn't impact your cash flow at all, would you do it? And the client says, absolutely. And you share with them the ability, if I could replace your mortgage dollars, the dollars you're spending every month, $1,200 for a mortgage, and take those dollars, would that be helpful? And that's how agents and advisors are selling more insurance. And that's a legacy goal. How will I be financially remembered? I was out at State Farm out in Illinois, and I asked them, how much of a concern is it for policy lapses for people who retire? And they said it's a huge concern. And I said they bought that policy at age 45, 50, 55. But now in retirement, something's happened and they can't make the payment and it's lapsed. But if you eliminate a monthly mortgage payment, that gives them the dollars they need to continue making their policy payments, or not having to convert their policy, or not having to cannibalize or convert their annuity. See, eliminating a monthly mortgage payment has a life insurance benefit. Number 6, creating a deferred income annuity. This is my favorite part of the presentation. Because the question, I said, make sure you ask Bob and Peggy this question. Bob and Peggy, what would life be like if you didn't have to make a monthly mortgage payment? And the first answer I gave, they'll say, boy, that'd be great. I could do X, Y, Z, A, B, and C. But every now and again, they're going to say, it's okay. We can afford to make the payment. We're okay. And then you say to them, that's great. What if we could take the payments you're making and reduce your loan balance, while at the same time creating a reserve fund just in case you need it in the future? Now, wrap your heads around that. What if we could take the payments you're making now to Bank of America, Wells Fargo, and just like every time you make a payment, your loan balance gets reduced, yes? What if we can continue to do that? You can continue to have a tax deduction, yes? But every time you made a payment, let's say $1,000, and it reduced your balance, you also had access to that money anytime in the future for whatever you wanted it for. Would that be okay? What are they going to say? Absolutely. And here's the part that most people don't understand about a reverse mortgage. You can make payments, and I want to advocate that the profile of the new borrower is that you should make payments. Now look at this on the screen. Here's what we covered earlier, the line of credit growth factor. You remember that? Seeing that earlier. So this says in year number 5, the line of credit is $121,000, right? And it continues to grow. Now I want to show you what happens if you tell your client, let's make a payment. Watch this, please. Let's make a $1,000 a month payment. You're already making a payment, and we can use a little language from the world of politics. If you like your payment, you can keep your payment. Some of you got that. If you like your payment, you can keep your payment. Now, what does it mean as an advisor for you to be able to do something for your client that's beneficial and they don't have to make a behavior change? You don't have to change their behavior. You say, we're not going to have you change your mortgage payment. We're just going to have you change your mortgage partner. So here's what it looks like. The first year they had the reverse mortgage. The principal limit went up because it always goes up. The outstanding balance went up, and therefore their line of credit went up. Now the difference is you had them make a payment. And when they made a payment, $12,000 a year, here's what happened. The balance went down, and because the balance went down, look at the bottom, the line of credit went up. And so every year they're going to make a payment. Loan balance goes down, line of credit goes up. So let's go out here to year number 11. Their loan balance is $9,000. Their line of credit is $332,000. Pause there, hit print screen, take a picture of this. Your client sends a check to Wells Fargo, Bank of America, $1,000 a month. They've done it for 10 years. They've now sent in $120,000. They call Bank of America, they call Wells Fargo and say, I've sent you $120,000. I'd like for you to send me a check for $80,000 because I want to do X, Y, and Z. Is Bank of America, Wells Fargo, Chase going to send them a check for $80,000? No. They're going to say you have to requalify. You have to get a new mortgage. We have to do this, that, and the other. And they said, but I paid you. I want some of that money back. There's no such thing. You told them, let's eliminate. Let's do a HECM exchange. Let's swap out your existing mortgage for a reverse mortgage, but the mechanics will be the same. You're going to make the same payment that you were making the Chase. Nothing's going to change. You're going to make it on the same day. But 10 years down the road, when you say, can I have $80,000, the reverse mortgage company is going to say, is that all you want? You see, because the line of credit, you were putting into that, and that was growing. Here I'm showing it growing at 5%. So let's go on out. Year number 13, you've stopped making payments. After year 12, no more payments, but we leave a $125 balance so the loan stays open. the line of credit, folks, continues to grow. So here, year number 21, clients in their 80s, late 80s, 90s, get out to year number 30. They've got $500,000 in the line of credit, $864,000. Why? Because you said to them, if you like your payment, you can keep your payment. You said to them, I want you to keep your payment but change partners. You said to them, you asked them a question, Bob and Peggy, what would life be like if you didn't have to make a monthly mortgage payment? And they said, it wouldn't be too bad. We can afford to make the payment. And you said, what if we could create a standby reserve that you can use anytime in the future as long as you're in this house and you're maintaining this loan? And you show them something like this, you see? You show your client that you made a payment, the loan balance went down, but your line of credit went up. And what are the chances, what are the odds over a long retirement that your client's going to need access to some of this money? What would that mean to your client? That means when they have a spending shock, a medical bill, long-term care, a house, a roof, a tornado, a storm, helping a child in college, they don't have to cannibalize their assets or annuitize. They simply can use money from their line of credit and pay it back if they wanted to. Folks, isn't that powerful? Absolutely. So why make a voluntary payment? Cash flow control, payment flexibility, tax-free, tax-deductible, bi-directionality, take it in, put it back, an exponentially increasing line of credit, a decreasing loan balance, and number 7, one of my favorite terms is equity insurance. You know what equity insurance is? Equity insurance is the access to the appreciating equity in your home, regardless of your home's value, now or any time in the future, as long as you are in that home and you have the loan in place. Equity insurance. It's the best insurance I think most retirees and boomers can have. Well, let's prepare to land the plane. Number 7, benefit of eliminating a monthly mandatory mortgage payment is creating a legacy now. I work with Sage Scholars. I have a program called Tuition Rewards. Dr. Jim Johnston has that. We've got about 500 schools that will offer tuition credits. And one of the things we do is we work with Sally Mae. And what we discovered are here are the typical cost of how a family pays for college. You see this? Parents' income and savings, 32%. Now, in that parent and income saving category, combined with the relatives category, is 37%. They didn't break it out for grandparents, but they're in there. The typical out-of-pocket cost for private schools, if you negotiate, is going to be around $1,500 a month. Did you hear that? Typical not the Ivies, but the typical run-of-the-mill private school in America, $1,500 a month. If Grandma and Grandpa have eliminated a monthly mortgage payment that was $1,200 a month, now they're able to give a legacy to Billy or Susie now by helping them pay tuition cost. And doing it this way, it doesn't reduce the FAFSA if you do it this way, so it doesn't cut out something else. Grandma and Grandpa can actually repay the student loan. They've saved the $1,200 a month. Little Bobby, little Jenny graduate, and Grandma and Grandpa have saved that money in the line of credit. They can now give a legacy to their grandchildren now. Number 8, long-term care and general health care. Nearly 3 in 4 cite rising health care costs, retirees, as their number 1 fear. Allianz and Fidelity, now this was 2016, 2017, it was even higher. Out-of-pocket health care costs for retirement could equal $318,000 for a retirement lasting 30 years. That does not include health care cost. That doesn't include long-term care cost. The U.S. Census Bureau said that's a whole nother factor. So if we're looking at $200,000 to $300,000 possible out-of-pocket cost for long-term care and medical care, how are your clients going to prepare for that? You see, by eliminating a monthly mortgage payment, $1,200 a month, that's what Bob and Peggy eliminated, $1,200 a month, they're able to do some pretty fantastic things if they have the health to do so. Don, what can they do? Well, they can purchase long-term care insurance. They can look at a long-term care plan that combines annuities and insurance and hybrids. A lot of folk will take an old annuity that they've been holding on to, turn that into a hybrid product. And the reason they didn't do that before, why, is because that annuity had liquidity. It was out of the surrender period. There's $150,000 sitting over there or $100,000 sitting there, and they said, well, we need that for liquidity. I can't do a hybrid plan. I can't do this, that, or the other. Listen to this. If you sell annuities, the number one reason people don't choose your program or product is not because they didn't have the money. They had $100,000 in a CD, money market under the bed, or they were willing to pull it from here because it made sense, but you didn't give them liquidity. You didn't eradicate or mitigate the liquidity concern. By eliminating their mortgage and oftentimes establishing a reverse mortgage line of credit, you have eliminated their liquidity concern, haven't you? Now that gives them the freedom to do something with the old annuity, with some brokerage dollars if they wanted, with the CD or money market. See, eliminating a mortgage gives the client the ability, or if they just wanted to buy a long-term care policy and said, I couldn't afford it, well, now they can because they've got cash flow created because they no longer have a monthly mortgage payment. Number 9, Family Resource Center or Cushion. I call this the Montini Bank of Scottsdale. Remember your client here, they eliminate it, and they have a line of credit. Here's their line of credit. Now, how many of your clients have children or grandchildren that have some sort of need? Sometimes it's emergency. Sometimes it's just kind of entitlement. Hey, mom and dad have money. Let's go get it. But sometimes there's a legitimate need. What if there was a particular bank? Mom and dad they have this money. Son or daughter need $20,000 or $30,000. That happens. I had a client that had a particular bar. He had some tax issues, and he owed IRS a huge sum of money, and they were going to take his particular bar. He had no way to get the money. He had tapped out from his own home equity loan. He said to Mom, can I borrow $20,000, $30,000, $40,000? And she was going to take that out of an annuity or just take it out of her qualified dollars. And I said to her, you could do that, but there may be a tax consequence with that. Is that the best way? Why don't we structure this as a loan? Why don't you loan your son? Consider not just a gift, loan him. You've got a bank. You've got First Bank of Scottsdale. That's your line of credit bank. Structure a note. You can do that. Loan him the money, 1% interest, and have him pay you back over 5, 7, 10 years, right? By creating and eliminating a mortgage payment, setting up a line of credit, you give your clients the ability to do some flexibility and some planning that could help their family and others. This could be a wonderful student loan account for their grandchildren. I'm not saying you have to give them money, but maybe this is a student loan dollars. Well, finally, number 10, as we land the plane, right size and repurpose. So there's a client that says, Don, I'd like to get rid of my monthly mortgage payment. So here's my client here, real client, several years ago, and I'm still doing this. The wife says, I'm concerned about running out of money. The husband says, I want to play more golf. I was playing more golf than this in my imagination. And I said to their advisor, let me show you a way to solve for the longevity concern the wife has and the lifestyle concern the husband has. They've got a $550,000 house. They've got a mortgage. They've got a big mortgage payment, $1,200 a month. So if we sell their home, we paid off what they have, they've got $380,000 left over. If we stop right there, what have we solved? We've solved pretty much of some of the other things you saw, items 1 through 9. But the husband can play more golf, and we can reduce the draw on the portfolio. But if we want to supersize it, we say, now, your house is too big, the stairs are too much, you don't want to maintain it. Let's do something called a HECM for purchase. A HECM for purchase is a way to purchase your next home using the HECM, where you have to pay about 50% down, and you have no monthly mortgage payment. So the client says, okay, Don, here's the price of the new home, $400,000. That's fantastic. The HECM for purchase makes around $220,000, a little more than 50% in this case. So we're going to subtract the HECM for purchase, permanent financing. Think of this just as a mortgage, because it's just a mortgage. We're going to subtract that from the $400,000, and your client has to add $180,000. Well, they had $380,000 after they sold the house, paid off the mortgage. And they said, that's great, Don. We're going to buy the house. And out of the $380,000, they take out $180,000, and they have $200,000 left. What have you done for your client? Number 1, you've eliminated a monthly mortgage payment. And I've just said all the things that could do. Number 2, you've added $200,000 back into their retirement. The typical person doesn't have that type of money in their retirement. And there are other hybrid things you can do with that. I won't cover that. But look what you've done. You've eliminated a mortgage. You've moved them into their final retirement home. They can take the money in cash. They can keep it in a line of credit. They can do part one or part the other. That's a whole nother webinar. But that big yellow number in the middle, $200,000, you have freed up $200,000 for them to repurpose into their retirement and eliminated a monthly mortgage payment. And folks, that's the 10 ways that eliminating a monthly mortgage payment can supersize your client's retirement. Let's review them. Creating a budget bridge, $1,200 more allows them guilt-free enjoyment. You can reduce the draw on their portfolio. That creates longevity. You can mitigate sequence risks or have a hedge for market risk. Defer Social Security. Replace the cost of long-term care insurance. Replace the cost of life insurance. You can help them to establish a Legacy Now fund. You can build a family resource center. You can help them make a payment and create deferred income stream, or you can help them to right-size and repurpose and move to a different situation altogether. Well, that's a powerful 10 things right there that eliminating a monthly mortgage payment will do. How do you implement this? I'm suggesting to every advisor that at every meeting, talk about housing wealth. If you're doing comprehensive financial planning, maybe you don't do it all by yourself. Maybe you're part of a team. But I want you to talk about housing wealth. Why? Because it's the most substantial part of a client's total wealth. It's significant. Talk about it. What am I talking about? Now, you're talking about cash flow creation, portfolio preservation, having a backup plan for risk and volatility, having a hedge for spending shock. Talk to them about this. Number two, give out some collateral education materials. I suggest every advisor have a few of these on file. We created a pamphlet at the HECM Institute called 25 Ways to Use a Reverse Mortgage. It's real simple. The person who invited you can get to that. Here's one, 12 savvy ways to use a reverse mortgage. I just sent this out in my email yesterday. 9 of them come from Investment News, and I added 3, and we created just a simple education material. Fonzie's not on the back, Fred Thompson, Magnum PI, no one's on the back. It's just straight education. This came from Forbes magazine, 5 ways a reverse mortgage can help your client's retirement. This was a wonderful article in 2016. I wrote the author and I said, this was fantastic. How did you come up with this? Where did you get your source material? He said, Don, I got it from you. He said, I was in your class. I just summarized your lecture. I said, can I use it? I want to develop it so other advisors can use it. And they graciously gave me the ability to do so. And finally, the American College had this, Making a Case for Reverse Mortgages and Retirement Income Conversations, an excellent piece featuring Dr. Robert C. Merton, who won the Nobel Prize in Economics. He teaches at MIT, who said that reverse mortgages are a solution, part of solution to the global retirement income crisis. And on page number 2, they have me right there. And then Dr. Wade Pfau is in there as well. And so those are the ways. Keep the reverse mortgage partner on speed dial and consider hosting an education workshop or webinar for your clients. I want to take a few phone calls, a few questions right now, So if you have a question, go ahead and type it in. It's going to take about 60 seconds to get to me, and then I'll answer your questions. Again, I'm sorry about the technology here. We were so excited when we put it into place, and I'll be calling Comcast because I'm not excited right now. I've done this for 3 years, and big snafu. So if you have a question, Jeffrey, can I get these articles? Yes, Jeffrey, you can get the 4 PDFs. Certainly you can. You can email the person who invited you to this webinar. Just email them. And if I invited you, email me. Dave asked the question, do you have examples that reflect the cost of the HECM? I do have examples of that, Dave. I don't have that in this particular webinar. This is part of the 5-hour certification course. But I had that. If you want something in particular, email the person who invited you or your partner, and they can give you a particular and specific breakdown for any clients you may have. Russell asked the question, can you do a HECM refinance? Yes, Russell, you can do a HECM refinance. There were people who got a HECM that 10 years ago, their home has appreciated in value. The interest rates have gone lower, and they may be able to refinance and get some more money out of that. Absolutely. You want to inquire if you've got clients that already have a HECM. Certainly, that's a short inquiry for any loan originator from Retirement Funding Solutions. They can take care of that for you. And Dave says, calm crap. Thank you, Dave. That's not encouraging to me, but it's but disappointing nonetheless. And David, another David asked the question, does the line of credit interest rate increase as the variable interest rate on the loan increases? Super question, David. And the answer is absolutely. The line of credit follows the interest rate. So every year, if you choose an annual adjusting product for your client, every year the interest rate's going to adjust on the anniversary up or down. If you choose a monthly adjustable, it will adjust every month up or down. So if we're in an increasing interest rate environment, we'd have to adjust all the numbers you saw on the screen upwards because the line of credit could be really, really big. Let me take one or two more questions because we're up on the hour because we fault technology today. And I'll wait 30 seconds. If you've got one or two more questions, fire them away, and I will answer them. All right. Brad, to qualify for HECM, is the minimum equity around 50%? Yes, for a 65-year-old, Brad, that's about the minimum equity up to the lending limit, which means the current lending limit is $636,150, which is the maximum home value amount that HUD values a house is $636,150. So about 50% of that if you're 50 years old. Well, Don, what if I have a client who's got an $800,000 home? I said, great. They're going to be able to get around. Their home's not $800,000 to the lender. It's $636,150, and that's the number they're going to use. Mark asked the question. I see the big slide you're on and the small picture of your next slide. It went back to that again? Oh, sorry about that, folks. I've got this double screen. I was trying to be sophisticated, so I'm sorry about that. And I hope that's a little better. And thanks, Katie. Yep. I see I did the wrong thing there. So, folks, I'm going to land the plane here, and I appreciate you all so very much. I'm going to listen to the recording. If the recording is bad because we had some gaps in the middle, I'll take some time tomorrow, Friday, and just re-record it, just me, myself, and then I'll send you that recording. But I've recorded the one today, and I'm going to send that to you anyway, so you can have it no matter how it comes out. So I'm going to stop the recording right now. Let me hit the stop button.